Good afternoon, everybody. My name is Danny Conforti, and I am a certified financial planner here at Pathlight Advisors. Today, we're going to be talking about planning for retirement at the early stages of your working career. So far in 2025, markets have experienced quite a bit of volatility, with headlines shifting between inflation concerns, interest rate speculation, and global events. We've seen plenty of short-term ups and downs. It's a good reminder that volatility is a normal part of investing, especially in an environment where uncertainty tends to move markets day to day. That's why it's so important to stay focused on the bigger picture and stick with your long-term plan. Reacting emotionally or making drastic changes based on short-term noise can often do more harm than good. Staying the course, being disciplined, and having a well-diversified strategy is ultimately what helps investors weather periods like this. Here we can see the long-term behavior of U.S. bull and bear markets going all the way back to 1942. The blue sections represent bull markets, which are periods of strong market growth, while the yellow sections represent bear markets, which are periods of economic decline. The key takeaway here is how consistently the market has recovered from downturns over time. On average, bull markets have lasted over 4 years with an average cumulative return of nearly 150%, while bear markets typically last just under a year with an average drawdown of 31%. This emphasizes the value of staying invested with a long-term perspective, even through periods of volatility. This is a lighthearted but very real example of what happens when we let emotions drive our investment decisions. It's natural to feel nervous when markets are volatile, but trying to time the market, getting out when things are bad, and jumping back in when things are better usually leads to buying high and selling low. The takeaway here is that successful investing is about having a plan and sticking to it, not reacting emotionally to short-term market movements. Volatility is just a part of the process, and staying invested through those ups and downs is what helps to build long-term wealth. During periods of extreme market declines, a natural emotional reaction can be to take control by selling out of the market and seeking safety in cash. This is due to loss aversion, or the fact that losses hurt more than gains feel good. The result of this action can be devastating because during periods of market volatility, the best days are likely to occur close to the worst days. This chart compares an individual who was fully invested for the last 20 years in the S&P 500 to investors who missed some of the best days as a result of being out of the market for a period of time. Missing the top 10 days reduced the annualized return by almost 50%. Missing the top 40 days resulted in a negative annualized return on the original $10,000 investment. Staying the course with a diversified long-term investment strategy may produce a better retirement outcome. Here's an example of an investing method we call dollar cost averaging, where you invest a certain dollar amount in the market at certain periods of time, regardless of what the market's doing. So if I buy 10 shares of an investment at $10 per share and it goes down to $8 per share, that's pretty painful. Just saw the balance in my account drop by about 20%. If I at that point go to cash and get back in when quote unquote things are better, which might be back at $10 per share, I'll only have $80 instead of my original $100. However, if I stay invested and I buy one more share the next pay period at $8 per share, I only need to get back to $9.82 per share before I become profitable. If I buy another share when the stock drops again to $7 per share, yes, again, it's painful seeing my balance drop. I'm not very fond of it, but I'm just going to stick with the game plan. I now have 12 shares and I only need to get back to $9.58 in order to become profitable. The good news is that your 401ks force you to dollar cost average by having you contribute every time you get paid. So we really recommend taking advantage of contributing to your 401k. It is sort of a set it and forget it. You don't have to worry about really what the market's doing when you're younger, especially. The key is to continue to contribute and take advantage of compound interest over time by dollar cost averaging. This example is meant to challenge how we feel about market downturns. If you weren't already invested and you heard that the NASDAQ was down 30% and the S&P was down 23%, you'd likely see a buying opportunity because stocks are on sale. But because many of us are already invested and have watched the value of our portfolios decline, our emotions often take over, and instead of seeing opportunity, we feel fear or hesitation. This is a great reminder that mindset matters. Volatility can create opportunities, but only if we take a step back, take the emotions out of it, and view it through the lens of long-term investing. Saving and investing early and consistently over a long time is important to retirement success. Here we can see different retirement outcomes based on various saving and investing behaviors of 4 hypothetical people. The consistent saver and investor reaches age 65 with substantially more than the other savers. The early saver and investor saved only 1/3 of the amount of the late saver and investor, but because of the power of long-term compounding on money invested early, the early saver accumulates more savings than the late saver. The consistent saver in green saves as much and as often as the consistent investor in blue, but keeps saving in cash rather than investing it. As a result, the funds did not grow as fast, they didn't outpace inflation, and the cash saver ends up with the least of the 4. Retirement isn't just a finish line, it's an ongoing journey that evolves over time. The way we live, spend, and save today sets a tone for what our retirement years will look like. It's important to remember that your financial story is more than just numbers. It's about aligning your life and goals with a plan. As we map out these goals, we need to think about what resources are required and how inflation could impact purchasing power over time. It's also important to recognize that preparing for retirement isn't just about how much you save or spend. Factors like time and risk management play key roles. It's never too early to start. The sooner you begin planning, the better position you'll be to enjoy the journey ahead. During your earning years, you should be thinking about whether or not your current career path is going to provide you with opportunities to accomplish your financial goals. Break down your goals into small pieces, outline your retirement goals such as age and income, how much do you need to save each year, assuming a pragmatic rate of return. Begin developing good habits of savings and investing today, making sure you're taking advantage of your employer retirement plans and possible matches. Have a good balance of saving, spending, and paying down debt. Time is our most valuable asset. Think of each paycheck you earn as an opportunity to save and invest for your future. At age 25, you still have a little over 2,000 paychecks ahead of you, plenty of time to build a solid financial foundation. As you move through your 30s, 40s, and 50s, that number steadily decreases. By age 55, there are only 520 paychecks remaining. The key message here is the earlier you start, the more opportunities you have to let your money grow and work for you. Time can be your greatest asset, or it can be your greatest liability, depending on when you choose to take action. That's why starting now can make a huge difference in your long-term outcomes. This chart helps break down what contributing to your retirement plan actually looks like in terms of its effect on take-home pay. A lot of times people hesitate to increase their contributions because they think it will take a big bite out of their paycheck, but when you see the numbers, especially on a per paycheck basis, it's far more palatable than it feels. For example, someone making $40,000 per year while contributing 1% would see roughly an $11 reduction per paycheck. That's around what most people spend on lunch each day. When you look at it this way, increasing contributions becomes a much easier decision because you realize the trade-off is small today for a potentially huge benefit in the future. And of course, if your employer offers matching contributions, that's essentially free money you're leaving on the table, so we highly recommend taking advantage of that situation. Here we can see what that 1% contribution looks like each year. Most of you, or at least some of you, will have a feature called auto escalation or something along those lines, where essentially you can increase your 401k contributions every year by a certain percentage until you reach a max percentage you would like to stop at. Here we have two people, and we're going to point out this example of increasing your contributions as time goes on. The person in blue, they both make $55,000 per year, just to set that expectation. The person in blue saves 6% from age 35 to age 67 and does not increase their contributions the entire time. They end up with a balance of just under $420,000. The person in red starts with that same 6% contribution at age 35, but increases their contributions by 1% every year and stops at 12%. They're both 67 years old, but the person in red has a balance of around $743,000, which equates to a difference of about $323,000 by only increasing their contributions by a mere 1% per year. So again, small price to pay now for a big potential payoff in the future. It's crucial to gain control of your spending habits early on in your career. We're not saying that you need to be super frugal all the time, but making sure you're taking care of saving and investing before you buy a brand new car or a bigger apartment can make all the difference in the long run. If you're starting a family or plan to buy a house, make sure your employment situation is stable before using your rainy day fund as a down payment. If you have goals of funding college for your children, consider opening a 529 college savings plan, which can provide some tax savings and funding for qualified education expenses down the road. An easy way to track your cash flows and uncover opportunities to save more is by filling out a budget. If you'd like a copy of this fillable PDF, please send us an email and we can get a copy over to you as soon as possible. It's tough to think about how much income you'll need in retirement when you're in your 20s and 30s. The general rule of thumb is 80% of your working income. If you're curious to know how much you'll need to have saved in order to retire, you can multiply your current income by 25 and get an estimated value. In retirement, we generally suggest a withdrawal rate of no more than 4% of your portfolio, which means that if you have $1 million in an IRA, you can expect to have around $40,000 of income drawn from that portfolio in retirement. Your employer match is not a prescription for how much you should be saving into your 401ks. We recommend that you save 10 to 15% of your income starting in your earliest working years. Investing in a target date fund is a good option within your 401k. It will become increasingly more conservative as time goes on. If you're not sure how much you should be saving based on your income and would like to discuss this, we're here to help. There are two primary ways to contribute to retirement accounts, whether that be 401ks, whether that be IRAs. There are pre-tax contributions, in which we call traditional contributions, and there are after-tax contributions, in which we call Roth contributions. With traditional pre-tax contributions, your contributions are made before income taxes are withheld. The earnings grow tax deferred, and you pay income taxes on distributions in retirement. So I'll give you an example. If you're making $50,000 now, and you put $10,000 away into your 401k throughout the year, you are getting a tax deduction of that $10,000 for the year. The $10,000 goes into the account, it grows tax deferred, and you pay taxes on distributions in retirement. With Roth, it's quite the opposite. Contributions for Roth are made after income taxes are withheld, earnings grow tax-free, and you do not pay income taxes on distributions in retirement. Same example, you're making $50,000, you contribute $10,000 to your Roth account, in this case a 401k. You do not get a tax deduction off of that $50,000, so you're still paying taxes on $50,000 of gross income. That $10,000 goes into the account and it grows tax-free. You do not pay income taxes down the road because you've already paid them now. So you're not getting a tax break for saving into Roth for the current year. The way I like to look at this is pre-tax is if you were to take a seed and plant it, you are not paying taxes on that seed. You're paying taxes on the harvest years down the road. With Roth, you're paying taxes on that seed that you plant, and you're not paying taxes down the road on the harvest. Some might say, well, Danny, why wouldn't we just do Roth? That makes the most sense in my eyes. Well, it really depends on what your income is for the current year and what your income will be down the road. If you're in a lower income tax bracket and you're in the earlier stages of your working career with good earnings potential, it might be worth it to favor the Roth side of things because you don't need the tax break as much as someone who is in a higher income tax bracket. Maybe they're at the height of their earnings potential. They could use that extra tax deduction, so we might lean traditional in that sense. If you're curious or just want to know if you're doing the right thing, whether it's saving in a pre-tax manner or saving in a Roth manner, or maybe a little bit of both, I'd be happy to discuss that with you, so please reach out. It's very important to make sure that you have an adequate amount of insurance. If you have people who are reliant on your income, looking at options for cheap term life insurance is something we encourage. Health insurance is a must-have to avoid excessive medical bills. If you own a home, double check to make sure you're properly insured. Disability insurance is something to consider as it will help to cover your income if you become incapacitated. Thank you all for your time today. If you'd like to schedule some time to speak with me, please send me an email or give us a call. I hope you all have a wonderful day.